What's up, everybody? Welcome to another edition of Zach's Live Trader. Here with you, as always, I am the bearded boy wonder, Dave Bartosiak, and today, my friends, we're talking about Deere. Ticker John Deere. Ticker John Deere. Ticker DE. As always, guys, I've got my chat window up. It's about a 30-second delay until when I see you talking and or when I can say it here live on the feed, but everything in the chat's live, so I think I can shoot it over real quick. Thank you guys for hanging out this morning for the morning after. And then, of course, now we're going to dig into John Deere here. So why don't we get started? Kurt, I see you asking, Moreno's at the Riviera Hotel. Have not. I haven't done a lot of exploring here in Miami yet, to be honest with you. A lot of working here in Miami is what I've been doing, and the fun time exploring, just, I don't know, a little bit. Like, I've gone on Lincoln Road to a few places down there. What was it, Yardbird, I think? Nice little spot for some food. I'm trying to find, I've got all the little like places in and around Sunny Isles Beach here, North Miami Beach. I do a lot of walking around here, checking out things. But for the most part, I haven't done a ton of exploring. That's going to change here coming up soon. I still got to get settled. I had a lot of trips, a lot of things going on. I'm actually going to go back to Chicago. Well, I'm going to Baltimore tomorrow. Then I got to go back to Chicago first week of June. And then I'm supposed to go to, well, I was supposed to go to Milwaukee. That's not going to happen, I guess. There's all sorts of stuff going on. I will put that on my list. I'm gonna check out a lot of these places. I went to a few places. I think the Sugar Factory down there in South Beach, and then I went to, well, of course, Wet Willie's. I know. I like the dingy, dirty, grimy places. Wet Willie's is right up my alley. So I miss Chicago too. I'm going to go. I can't wait to be in Wrigleyville. I can't wait to go to Langs. Langs is my spot. Jeff, if you hated Chicago, you didn't go in the right time with the right people. You can say a lot of things, but hating it? Come on, man. You just didn't know. You didn't know the right spots, man. There's something for everybody out there. Okay, let's go ahead and get elbow deep here into John Deere. So as always, price consensus EPS surprise chart. Black line corresponds to the right y-axis, which is price. The little red arrows, earnings misses. Green arrows, earnings beats. These multicolored lines represent the evolution of our Zach's consensus estimates over time. Here's the interesting thing. That you've got these sort of negativity, maybe, not so good. Really all the way up through 2015. Yet the stock was just kind of sort of chopping around, going sideways. Then all of a sudden, it's a little bit of a trough. Things start to tick up, and the stock goes crazy. And by crazy, I mean crazy. For a stock that had spent a very long time, a couple years, 2.5 years, between 80 and 97-ish, just chopping around, to all of a sudden decide that it's a $113 stock. And a lot of this move came here and beyond, right? So what happened here? Well, you see it. If you're wondering why, ticking up. Don't go to Chicago in the wintertime. Don't. Just don't. If you have a chance to go to Chicago in the winter, don't. It's terrible. It's the worst. Absolute worst. Well, I'm sure there's places that are worse, but don't go to Chicago in the winter. Okay, so that's what we're talking about here. We've got some really nice beats and then this recent trend of increasing EPS estimates. So that's good. And again, these guys make big bucks. You're talking $4, $3, $4, $5. Push it up. That's what we're talking about, right? Lots of positivity here recently, but is it enough? So, you can talk about a lot of things here with John Deere, right? Probably a good chunk of it, MAGA trade, right? Trump trade, you could argue. Part of the reason for this rally, but really it's not just that, because you do have these EPS estimates, right? So it's just a lot of positivity, lots of good stuff going on in the short term. Let's look at the detailed estimates page. It is and while I do that, let me get this Zach's research system going, popping up while we're looking at this. So Zach's ranked number 2 buy right now. Let's get back to what's going on here. Zach's ranked number 2 buy, value style score of C, growth of F, momentum style score of B. So that's all good and well. They're going to report before the market opens. Oh, man, before the market opens tomorrow. Oh, man, sneaking up on us. I better talk fast. They're in the top 6% of our Zach's industry rank here. Man, it sure is taking a while for my ZRS to load today. Top 6% of our Zach's industry rank here on Deere. Looking at the revs, not a lot of revenue growth here. Current quarter only 1.9%. Next quarter looks like 6.29. Current year number 3.4. Next year 4 and a little over 4.25. Look at the EPS estimates. Just under 9% for the current quarter growth. Next quarter we've got a contraction. It's interesting to see. Next quarter contraction. Current year 2.8. Next year though, it's going to be great next year. I hate it when companies do this. You guys know I hate it when companies do this. Down the line, yeah. But this is encouraging. Over the course of the last week, 4 analysts have increased their estimates for the current quarter. 2 have done so for next quarter. 4 for next year, or the current year rather, 3 for next year. So you've got some bullish activity all of a sudden, and now this is great too. Look at the magnitude of this move. So our Zach's consensus estimate as a result of these earnings estimate revisions has gone from 144 to 170. Next quarter numbers have gone from 138 to 152. Current year number from 440 to 495. Next year from 5.25 to 561. So all very bullish behavior on the EPS front. So that's actually great. And if you look at the surprise history, there's been some real nice surprises coming out of John Deere. So this is all very good and well. Good stuff happening right now here on the detailed estimates page for John Deere. All right, let me bust out my top secret G14 classified Zach's research system. I don't want to look at the surprise part yet, but so ignore this. Pay no attention to what's happening here. I want to go back and look at these revenues a little bit, and I want to see some Zach's rankiness also. So the revenues, we got that sort of snapshot on the site, and we're going to get a little bit more of a detailed view here. Or at least I assumed we were going to get a more detailed view because this is not much more detail here. Okay, well, thanks for nothing there. So it didn't get too much. Not retail discount. Same industry. Keep it in the same industry. Bruno, I'm going to go out on a limb and say that the Trump trade ended December 15th. For sure. I think the Trump trade was here to here, and that was it. Here, done. Small caps of the Russell, done. Okay. Let's do a little technical analysis on Deere. Pull up my CCI, pull up my CMF. And what do we got? All right, so let me put this all into view so we can see what's going on. Okay. So a couple of good things happening here on John Deere year to date. First of all, we've got mid-December. I'm saying the Trump trade Election day. All right, let me revisit this. Hang on. I got to do this. I can't leave you guys hanging like this. So election day until mid-December, and that was it. This was like, so what you had here is regional banks. It's a big chunk of this move. It's regional banks, infrastructure plays here in the U.S., basic materials, that kind of thing. Right there. And then since then, like, we've been in this very quiet period of a 6-month consolidation on the Russell, pretty much. And the Russell's more domestically inclined. Vast majority of the profits in the Russell 2000 stocks come from the U.S. here. So, and a big chunk of those was regional financials. Okay, so there we go. Back to business here on John Deere. Sorry, sometimes sometimes I just spout off this nonsense, and I just assume that you guys are following along with exactly what I'm saying when I say all these crazy things all the time. So sometimes I gotta stop myself from just rattling off all these buzzwords and that could come across as nonsense for you guys. And I gotta take the time and come down and reel it back in for you. So I appreciate when you guys throw it out in the chat there, because it helps me kind of slow down and because I want to kind of clarify what I'm saying too. So keep them coming, my friends. Keep them coming. Okay, so back to John Deere. They've been up. This 50-day moving average has provided some pretty good trend line support. Recently, we're kind of chopping around a little bit, but that's okay. Market's chopping around a little bit. I'm going to zoom in on this just to give some more perspective, because it just doesn't do it justice when we're coming out here when the stock was at 76, and then now we're kind of fighting our way through the the 108s. But what I do want to point out, though, is the positive direction in the money flows that we've seen recently as the stock is kind of chopped along sideways. That's good. That's a good thing. Okay. So now we zoom in a little bit and can get some more perspective. Floors on Deere, 107s. Lot of volume here. 110. It's also a swing low. So that should be some support. And that happened to happen at the 50-day moving average also. Pretty good. Now we're coming down the last couple of days after being at all-time highs, right? So, and the market got killed yesterday, and these guys barely budge. That's pretty good. And then today, probably selling at the open, I'd assume, and then starting to rebound. Yep, sure enough, selling at the open, and now we're rebounding. So the bids are coming back in. So that looks good, at least in the short term here for John Deere. Okay? So 110, 107, and then you got the all-time highs, 115 to the upside. Overall bullish trend, things are looking okay. Commodity channel index has come down from overbought through the zero line. This is a sell signal. So you have a commodity channel index giving you a sell signal right now. So, but we're still above the 50-day moving average. So I would say mixed reviews on a technical perspective for John Deere. Okay, now let's get back to the options chain. Side-by-side view so we can get an idea. 112s, 113s. Let's do 113s. This is almost at 113. Pull up the handy-dandy calculator. The at-the-money call is 229 by 245. We'll call that 237. At-the-money put, 299 by 315. We'll call that 307. So that's 544 divided by the 113 strike price. Basically looking for 4.8%. So $5.50 essentially. A little over $5. the stock here. So it's at 112.70 plus, what did I say, 540 puts you 118. And then 112.70 minus that 540 puts you 107. So 108s to 107s, right? 108 to 107. 107, or 118 rather, 118. 107. 107 sounds familiar. That's good. 110 sounded familiar also. All right, let's move this. Let's move out. Not going to mess around in this front week. Let's go out to the front to the next month. See what we can find. Changes from a side-by-side to the stacked. Take a look at where we're seeing some open interest. Shouldn't come as a surprise. 110s, 115s, 105s. Okay. What about here? Oh, that's the big one. 10.8 at the 110s. 8,100 contracts at the 100. Interesting. Very interesting. Okay. So this is kind of frustrating, though, because there's no 112. Let's see. Maybe we don't have to go all the way out there. What if we looked at the June? Okay, so we've got some, not a lot of action here June 2nd, though. I like to do this sometimes, guys, just kind of scour these weeks. Not a lot of open interest here. And just next week's, a few hundred contracts here and there. Here and there. All right. Short-term gratification. I'm into it. I'm into some short-term gratification today. Okay. So let's keep this May 26th options chain open. And let's think credit spreads. The 107 is going to be pretty conservative, I think. The 110 less so. So selling a put spread out at 107. Come on, bar chart. They love doing this to me. Selling a put spread down at 107. Let's see what sort of opportunity this presents us with. Of course, just 107, 106. Sure, why not? Let's just price this out. The 107 put, we're going to get 115 for selling that 107 put, simultaneously buying the 106 put. You're going to give back 94 of that, so that's 21, 79 cents at risk, 26.5%. I like it. I don't know about you guys. I really like it. It's just a week out. It's on the other side of 107. It's further than what the options market was pricing in, and it's where our chart showed us was a lot of support. That's annualize that, right? And when I say that, guys, think about it. We go out a week and a day, and we can make 26%. So if you went out 2 weeks and 2 days, could you make 50% on a different trade? You see what I mean? So when you can get a really quick turnaround on these, it's attractive. I'll look. I know you guys want me to. I'll look at that front day. I'll look at tomorrow's just to see if there's. Let me look at tomorrow's. Just to show you really quickly the comparison and how much more money we get for doing that. If we get more money, because I don't know that we will. So if we only go 1 day out, selling the 107 put, and this is tomorrow's expiration, you get 94 cents. Simultaneously buying the 106, you get back 75. So this is 19. 19 at 81 is 23%. Huh. So if you can make 23% in 1 day, maybe that's better. I don't know, guys. What do you think? Do you want to look at the May 19th or the May 26th? Maybe we just look at the 19th. Maybe we just look at this expiration. Because the 2 cents difference in the credit. There you go. Now we want to get more calendars. Okay, guys, I see what you're saying to me. You want the calendar. Let's do that. So this is what we'll do. I'll do 2 credits and a calendar. How about that? So here we go. I'll do the bull credit. Will be short the May 19th, 107, 106 put spread for 19-cent net credit. Right? Let's do that. Okay. So now, what if you're a bear? So we said 118s is where the bears were. So way past the 52-week high. Doing it this way. If you notice, there's not as much love here. If you sell the 118 call, you're going to get 73 cents. Simultaneously buying the 119 is 57. So that's 16 cents. That's your net credit right there. If you're going to do that to get 16 cents, you might as well push it down another buck and get the same 16 cents. So if you sold the 119 call, 57, simultaneously buying the 120, 41. So there's your 16 cents, 84 cents at risk. You can make 19%. So I'm going to say bear credit is short May 19th, 119, 120 call spread for 16 cent net credit, right? Okay, that's the bear credit. Now, rather than do, let's get a little diagonal, shall we? And put together a debit. So obviously, guys, I'm going to go with the bullish side here. So I'm only going to show you a bullish side when it comes to this diagonal. Okay. So let me pull up another tab, another bar. Actually, let me just duplicate this tab. There we go. We're going to put this one here. Put the other one here. And this should look nice. Okay. So we're going to change this to that. Where was I? The 9th? Is that where I was? Or I was at the 2nd? Yeah, the 9th. There we go. Okay, guys. So we can go long at the 112 or the 113. Look at the 113. We're essentially at 113. So this is the June 9th expiration. So looking at going along that 113. And then here, you're going to go short in this front week. So it's only like one day. And you're going to go short. Okay? Now, remember, just like when you're putting together a call spread in the same contract month, you buy the closer to the money and then sell the further out of the money, right? So you go sooner. You're still going to sell the one that's a little bit further out, right? Then if it rallies up, then whatever, you're still going to lock in some profits. So we said, 118 was the upside. Was the upside there. And just like I like to play my little trick where I go with the halvesies, let's look at what halvesies looks like here. 116s. Let's just price this one. Price out the 116. Okay. So, if you buy the June 9th $113 call, midpoint's 315. Simultaneously selling to open the 116 call that expires tomorrow, you're going to get back 122 of that. So now your net debit in this case is 193. Okay? So this one, if this rallies big time, right? You're going to get what? You're going to get the difference in strike prices, which is $3. The 193, you're only going to make 107 on the 193. If it rallied up right away, boom, you would make 55% if it got over 116 right away. Now, if it stalled a little bit, it didn't get there in the beginning, right? And then it finally caught on and then it rallied. You're going to be long that 113 call, and it's only going to have cost you 193. So you're going to have that 113 plus the 193. Your cost basis is going to be 114.93, and then you're going to participate dollar for dollar anything up above that. Okay? And then your upside potential is virtually unlimited to the upside. Okay? So there's that. There's one example. Now I want to go back to this 118 of where the market was. Market was at 118. The math here is going to be a little bit different. So in this case, you're still going to get 315 for buying rather. It's still going to cost you 315 for buying the 113 call. If you were to sell the 118, 73 cents is what you're going to get back. So in this case, your net outlay is 242. Now, the money that you can make here is going to be different because 118 is the strike price. So if this rally is way up above 118 that first day, the money you're going to make is the difference in strike prices, which is, $5 minus what you put in. Now, it's going to be a little bit better than that anyway. And let me explain why. So if you were to go ahead and buy this 113, and let's say in one day the market rallies and it's up above 119, okay? Then what's going to happen is you're going to get like this $5 is the minimum that you'll be able to get because you're saying that this 113 is going to be worth at least $5, right? Because that's just the intrinsic value. But this is basically, pretty much worthless because it just gets called away from you. But you're going to have to go ahead and sell whatever this call is at. So odds are it's going to be worth more than $5 at the time. So then you're going to get the $5 plus the juice. So you could end up making a little bit more money on that, right? That's something that you're going to have to see actually in action. You're going to have to see it happen in order to understand. But this is sort of, these guidelines that we give to say, okay, this is where we're at. So again, 315 minus the 73, so 242. Again, the difference in the strike price is $5 minus the 242. Talking 258 on 242, you'd still double up, which is awesome. But the thing is, so now 240, it costs you 242 for the 113 call. So your break even now on this becomes 115.42. So you need a little bit of a rally. Okay. All right. So now another tweak to this. I see in the chat, Mr. Newman is throwing out this 112, 119. So we'll price this one out. So 112 is going to cost you $365 to go along that 112. Shorting this front week 119, you're going to get back 57 cents. So your net outlay is going to be more expensive here. It's going to be $308. Now the potential amount of money that you can make on this one, it's going to be the difference in strike prices here is $7. Okay, so 700 minus the 308, so you can make 392 on the 308, 127%. So you got a little bit more upside potential. However, you are paying a little bit more for that, right? So now in this case, It's the, what did I say, 303? 308. I think it was 308. 308. So 115.08 is your break even here because you're further in the money going long on this call. Or you are in fact in the money going long on this call. Okay? So lots of iterations of this thing. You guys still get what the overall sort of feeling is, right? What you're trying to accomplish. Okay? And you can move these goalposts, you can tweak them, massage them in any way that you see fit. And essentially what you're doing is you're just using the price of this front month or front week contract to offset the cost of your further outdated call option. So you still have a bullish tilt, but in this case you don't want to pay the 365, right? You want to get the benefit of the implied volatility fading off of this after the earnings, and plus the time value. It's going to be nothing. It's gone, right? So there's that. So I do want to compare this directly to going out sort of the traditional way that we've been doing it. And really what the difference is between them is not in how much money can you make, how much money you have at risk, but in the upside. Okay? So actually I'm going to leave it right here to give you this example. So in that case, going long the 112, going short the 119, and you see what that was, the 308 net debit. Now I'm going to show you the math on if you keep the strike price the same and were to go in the same month, like we used to do, or the same expiration, just to show you guys the example. So it's 365 for buying the 112 call, simultaneously shorting the 119 call in the same month. You get back 111. So your net outlay is less on this. It's only 254. But here's the difference. Your upside is capped, right? Your upside, Bill, we did. So your upside is capped at 175% in this case. So you're capped at 119 on this side. In this trade, as long as it stays below 119 in this front week, then you participate in everything above 119 after that, okay? And this is specifically why, if I'm looking at this and I say I think it goes to 119, I think you're okay encroaching a little further in on this. Because if you're saying that, like, okay, 119 I think is where this thing can go, then I think you're better off selling that in the actual month that you're in, right? Because if you're saying, like, that's as far as it's going to go, because your advantage in selling this front month is that you don't think that's as far as it's going to go. You think it's going to go more. So I think you can encroach in here a little bit and say, okay, the first day it doesn't react that well, but then after that I think it's going to rally a lot. You see what I mean, guys? You see the difference there? So yes, and again, so this is one of those things where you could find a way in a week to hate yourself either way, right? It's not what I'm in the business of doing here, and we can second guess ourselves all. And again, I'm not saying, somebody's idea is not what I do absolutely. I'm just giving different perspectives. That's all, right? The thought process you guys got to be going through when you're putting these together. So if you tweak it a little bit, let's say you go 112, 116, then it's 365 long on the 112. You get back 122 on the 116, so 243 is your net outlay on this one, okay? Now, so then what I want to have happen in this instance is I'd like Caterpillar to stay below, or Caterpillar. I saw Bill Phillips say butterfly and I said Caterpillar. John Deere stay below 116 just his first day, and then after that start to leak up closer to 119 and beyond. So then it becomes more attractive, and that's essentially what you're saying here, is that post earnings drift is what's gonna have to happen, right? So there you go, guys. So what's an official trade? I mean, geez, we could cut. I'll do my official one, just to track. So I'll say I'll track here is long June 9th, 112 call, short May 19th, 116 call for a 243 net debit. Okay? Make sense? All right, guys? That's what I'm going to say. That's what I'm going to do. Ugh. Man. I swear. Let me tell you guys. Lots of numbers. Lots of options chains. Lots of stuff here. Newman, keep your idea. Do your idea. And talk about it. We'll talk about it. We'll look at it, and we'll follow up, and let's keep that, and let's talk in the future. We'll talk about it. All right. There we go. All right. So that's it, guys. Is there a lotto ticket on John Deere? Is there a lotto on Deere? The lotto is a breakout of 120, I suppose, right? The lotto is that these guys at 120 are right, and this thing, oh, great. This thing just goes crazy. So the lotto is a 120 call. There we go. All right, folks. So that's all I've got for you here today. I got to get my life together here. Get it together. I got to pack. I got to go to Baltimore tomorrow. Well, I can't pack yet, though, because I still have, I got to do the good, the bad, and the ugly, not to mention, I've got a lot of stuff to do with Home Run Investor, Momentum Trader, all sorts of stuff. Maybe I could find a trade. What's happening with Baba right now? Still coming back. 118.46. That looks nice. What's good in the rest of the world? Where's Amazon? 955.86. Oh, man, this is going to cut it close, isn't it? Where's the VIX? How much is the VIX falling apart? Yep, coming back down. UVXY, 1462. Man. Yen, oh, boy, all sorts of fun stuff. Under 111. All right, so... All right, guys, so thanks so much for hanging out with me here today on Zach's Live Trader. I'll shoot out the good, the bad, and the ugly review later today. Mañana, I am out. I am on a plane going to Baltimore. I will be back in South Florida on Sunday night and back with you wonderful people on Monday. Although you guys know I don't typically do stuff on Monday. So... All right, everybody, so thanks so much for hanging out with me here today. I hope all of you have a fantastic weekend and you make a bunch of money trading the rest of the week. So thanks a lot, and I'll see you all very soon. Thanks, guys.